I recently had a chance to talk with serial entrepreneur Johann Moonesinghe about his experience as a founder and as an investor. We talked about what he's seen in terms of the COVID crisis impact on startups and the kinds of strategies that seem to allow them to survive. We talked a bit about his experiences as a gay founder and the way communities around minority populations actually can help new founders. We also looked at how he chooses the companies he wants to invest in and some of his top tips for new founders. Johann, welcome to Fill the Boot.
Thanks, Lance, for having me.
It's great to talk to you. I know we used to talk all the time, but it's been a long time. Why don't we start off? Tell us a little bit about your company, because I think you're doing some interesting things.
Yeah, so we are a restaurant finance company, but really have reinvented the way that we finance restaurants. And my background, as you know, Lance, is really in tech. But I started investing in restaurants because I love food, and that was maybe seven years ago. And then I actually started a restaurant incubator in Washington, D.C. to help chefs, learn things that they're not great at about running a restaurant. And then my idea was I could invest in them and, kind of increase my odds of success by having them go through that incubator. And I had financed about 30 restaurants personally at that point. And I had a chef in the incubator who really awesome chef, great food. And he wanted to start his own restaurant, and he wanted me to fund it. And I looked back at those 30 restaurants and probably realized what a lot of people who've financed restaurants realize is that restaurants are not the best asset class to invest in. And so we basically created inKind, which our model is that we buy food and beverage credit in a restaurant, and a lot of it. So we'll buy $100,000 in food and beverage credit from a restaurant. That gives them the cash to open, to expand, to build a patio. And then we turn around and sell that credit to consumers. And we sell it in something we call them house accounts, which are basically like high dollar gift cards. Consumer gets a bonus. So, pay $1,000, get $1,300 in credit. It creates this sort of awesome loyalty to the restaurant because, you can imagine, hey, where am I going for dinner tonight? Well, I'm going to go to a place I have $800 in credit to go to. And when you go, you spend 80% more per visit. And the restaurants love it because they don't have to pay us back. It's not a loan. We don't take equity. They don't have to have other partners. And, as an equity investor in a restaurant, there's a lot of headaches that you don't necessarily want to deal with. When the chef wants to buy new plates, but you want a distribution, that's not a discussion that's a fun to have. Whereas with our model,
and of course, you're not moving towards an exit with a restaurant probably either. There's not going to be some IPO or 20x kind of acquisition in most cases.
Yeah, and really, as an equity investor in a restaurant, if you break even, you're doing better than most investments. But it actually is that's actually core to some of the issues with equity investments in restaurants is that typically in a typical restaurant, it's structured so that the majority of the profits are distributed to the investors till they're paid back. And then the owner or operator starts to share in those profits. And usually it takes about 3 years. That's its plan. The pro forma is for a 3-year payback for the investors. So sort of and usually it takes longer, but in your best case, you're spending the operators in there working really, really hard for 3 years and working 100-hour weeks, and the investors are getting the profits, which is fair because they're the ones who financed it. But it just creates a weird dynamic between the operator and the investors. And so there will always be equity investments in restaurants, and there'll always be loans. And we don't provide enough capital to open a whole restaurant. We're just part of that cap stack. But I think our financing is much more attractive to the restaurant and to be honest to the investors. So we raise money from investors to provide to the restaurants. We have a credit fund. And those investors, all of them in the credit fund, have formally made, prior to investing in our debt fund, have made equity investments in restaurants. They love food, they want to support local restaurants, and they've all kind of dealt with the headaches and maybe of the asset class as equity investors. So now they're like, great, we can put it into inKind, restaurant gets funding, we get a return, and we don't.
Right, and the real investment return that they want is for this restaurant to exist, for them to have this place to go, and it's kind of their place. Are you seeing restaurants using this to fund sort of the outdoor patios for COVID dining? Is that kind of a big area for you?
Yeah, exactly. Outdoor dining is really big. Where right now, figuring out, in New York, DC, anywhere other than, California or Arizona, or maybe here in Texas, the winter's going to be rough. You're not going to be able to have your outdoor seating. You're not going to probably be able to have indoor seating, depending on what happens with COVID here. So we're financing a lot of heating for outdoor patios and, things like that, which are going to be critical for restaurants through the winter. To get through the winter.
Now, you talked about with your earlier strategy, you sort of had this incubator. Do you find that restaurateurs don't tend to be sort of business inclined? They needed a lot of help in that area?
The interesting, so I would say restaurateurs, the best restaurateurs are very business inclined. They may not be the best chefs, but they're very business inclined, right? I think the best chefs, usually what happens with a restaurant is you've got a great chef, an independent restaurant. You've got a great chef who, is awesome at producing food, and then opens a restaurant and realizes that running a restaurant is a lot more than just producing great food, right? It's a really tricky business in that you have to be great at production, which, is what they're good at. But also, distribution, right? Like you have these people who are eating there. You have to be great at social media, because that's how you're attracting patrons, and you have to know how to, a lot of times, they don't use a, commercial real estate agent. So they try to go and they find a deal on their own. So now they're having to be great, at real estate selection and all of these other things that they're not good at. And that's usually, I met with an entrepreneur chef, this week, a couple days ago, and she, awesome cook. Awesome. Like her food is excellent. And she was telling me about the real estate deal that she's in. And I was like, whoa, well, that's really not a good deal, and now she's tied into it and she's put in hundreds of thousands of dollars. She refinanced her house to do a build out. And, it's just like all of these stories. So the incubator, I think, was really, really helpful because we were able to help, six restaurants opened outside of the incubator and really help them to be successful. But I think my experience from the incubator was actually started because I was part of TechStars in their very first class. And I had my very first startup failed after about 8 months. And it was, I didn't know what I was doing. My college roommate and I, we were, started a company, and then our next company we did through TechStars, and just having that support and guidance and mentorship made the difference. And, we were able to exit that business. And I think that's how we designed the food incubator, was for the restaurateur who, he's good and passionate, but just doesn't have the knowledge to do the other parts of the business, so the support structure.
It does seem like it's a very similar problem to most startups where, for example, instead of being a great chef, you're a great coder, but you have no idea about anything else.
Absolutely.
Now, you gave some really good advice. You wrote an article really on in the COVID talking about what restaurants needed to do in an emergency. And I thought I was incredibly impressed with that. And maybe you could talk just briefly about kind of some of the high points of what you talked about there. And what is your thinking now that we're much deeper into this crisis and it looks like it's not going to be a short-term hit?
Yeah. So, some of the advice we gave restaurants really early on was talk to your landlord, renegotiate your deal with your landlord, make sure that your revenue is going to be way down. So, the landlord needs to understand that. And typically the restaurants that were doing well or okay or paying rent, and the landlords are happy with them, almost in every case, they said, okay, we'll work out a deal with you, right? Because the landlord doesn't want an empty space. and especially after COVID or during COVID, releasing that space is a headache. And in our portfolio, we financed in the last 3.5 years about 450 restaurants, and we've actually only seen one closure, permanent closure, and everyone else is operating at least in a to-go capacity, at a minimum. And it really depends on the state that they're in. Here in Texas, restaurants are busy. People are going out. Last night, I went out for dinner, and I had to go to the third restaurant because the first two were completely full on a Tuesday night. Like you can't even get a table here. Whereas in DC, people are a lot more cautious. And so in DC, people are eating out a lot less. So we have a high density of restaurants in DC as well. So we can just see that in the numbers. So it really depends on where you are. The restaurants that have been able to tweak their model to operate with lower labor costs, to really maybe add more items that are good for delivery, take away items from their menu to streamline them so they don't need as much labor in the kitchen to produce them, to take advantage of a lot of the changes in liquor laws where they can now deliver wine and they can deliver cocktails. Those restaurants are actually, from a net perspective, might be doing better than they were doing pre-COVID. Certainly their gross revenue is down, but they've been able to bring down their costs. There's been a lot of government support that we were hoping for another round. Unclear what what the president's thinking there exactly is. He said something yesterday and something different today. So we're hoping there's another round of funding to go and really support small businesses and restaurants. But I would say, just like in tech, you have the operators who can pivot and can innovate, and those guys will make it through. And some of them are actually more profitable now.
Yeah, it's really in Healdsburg. It's been interesting to watch some of the restaurants adapt. Most of them are really high end, and our 3 Michelin star restaurant was doing family meals for like $130, which you can't get into single thread for that. That's $800 for two kind of place. Amazing food, but they were innovative, thinking about what's going to travel, what will make it home in your trunk, reworking the menus to optimize around the new world, and kind of interesting over the weeks to watch them improve and learn these new systems and what's going to be the best, because none of these places had ever done takeout at all before.
Yeah, absolutely. I was talking to my dinner last night was with one of our restaurant groups that we funded out here, and I had dinner with the CEO, and he was saying during COVID, they actually started doing their own delivery because Uber Eats takes, call it 20 to 30%, depending on how you negotiate with them, and you don't really tip. You don't have the opportunity really to tip the restaurant. So what he was saying was, if he had his own his own delivery, which was they were doing, it's $100 order. That the people were really generous, especially during COVID, with delivery, and so he charged a $10 delivery fee, and then they'd tip 20-30%. So his getting gross $130, $140 in that order, versus if he did it through Uber Eats, where he's getting $70 on that order. There was a big swing, between doing delivery through Uber Eats or doing delivery himself. And he, as a sophisticated operator, did the math and said, I'm just going to hire some delivery people and do it ourselves, or repurpose some of our wait staff, and was able to be very successful.
Right, and you get to keep paying your wait staff rather than having to just lay them all off, right?
Yeah, exactly.
So I want to pivot here a little bit. I know early on you were very early to look at equity crowdfunding. And you were doing that for the restaurants. And I know you spent a lot of time exploring that as the laws were just starting to evolve. And I thought I'd ask, what's been your experience with that? What's your thinking about that as a venue for funding businesses? And do you have any experience with who is a good candidate for that kind of fundraising?
Yeah, so we were the first people to equity crowdfund a restaurant in the country. So we worked with the DC government. We ended up ahead of the federal change, the SEC changes. We were able to crowdfund a restaurant in DC with Washington DC residents, and it took a lot of work to get that first one done, and then we were able to crowdfund a couple of more under those DC laws. And that was probably in 2015 or something like that. Overall, like, I think for restaurants, as we talked about earlier in this call, are a tricky asset class. You know, as an equity investor, it's a hard asset class. And so allowing people to sort of crowdfund for equity for restaurants probably isn't the best model. That's why we really moved away from that, because, you know, like you said, somebody who wants to invest for equity in a local restaurant in the neighborhood wants that restaurant to be there, isn't particularly concerned about the return, and, you know, is more wants to support their community and have a great restaurant they can go in and eat at. So I think if you make it into a really investable, or try to make it into a really investable asset, it's hard, you know, and at its core, equity crowdfunding is around making investments. You know, it's not around, you know, supporting a local business. And so we've seen, there's still companies that do it, and usually they don't structure it as equity, they structure it as debt, which probably is a better way to structure it. We didn't do that, we did it as equity. Debt makes more sense, but we've also seen that those restaurants, you know, it comes back to, same as true with startups, where you might have negative selection for the businesses that are equity crowdfunding, right? Because the really good deals are going to the, you know, the active angel investors or the venture capitalists. And, you know, when they sort of pass on those deals, then you end up crowdfunding. And so we definitely saw that in the restaurant business was, you know, if everybody else has sort of passed on this, then, you know, like, then they can try to raise on an equity, on a crowdfunding platform, which to us isn't the point. Like, the point for us, the reason we really wanted equity crowdfunding was because we wanted people to have a sense of ownership over a local restaurant and come in and spend money and come in frequently and, you know, become the best patrons of that restaurant. And that was true. We saw that people, when they invested in a restaurant, they'd bring their friends, they'd show off their restaurant, which was awesome. Exactly what we wanted. And inKind is sort of an evolution of that, where somebody can buy a high dollar house account and be a VIP at that restaurant, but they don't own equity, and we don't deal with any of the, you know, payments and the, you know, like, which is hard for the restaurant.
And you find that people still have sort of a similar level of kind of pride of ownership or association with that as well?
Not, you know, not exactly the same. Of course, if you're you're an owner, as an equity investor, you're an owner, that's going to be a little bit more pride. But I definitely have data, you know, when somebody buys a high dollar house account, you know, they have a house account at a restaurant, they spend 400% more per year at that restaurant. They come in 2.5 times as often, you know, so yeah, you see behavior. It's not the exact same as being an owner, but probably overall, with all sort of the downsides of having, you know, 400 owners, like, it's a better model.
And that's certainly a non-trivial lift. You know, that's a big increase in sales to those people.
Yeah, exactly. And that's why the restaurants we work with, you know, they really love it, because they're not giving up ownership, they're not paying back a debt, and they're really just getting a lot of awesome customers who come in a lot and spread the word of their restaurant.
It's almost a bit of a Patreon kind of model, where people are enthusiastic fans and they're getting maybe some special access. I mean, it's not exactly the same, but I think it fits into the same psychology of the reason people get involved in these.
Absolutely. Yeah. And I think inKind, so that was sort of the evolution, was, okay, we know that we want to have people who are big fans, or, you know, Patreon sort of model with restaurants. How can we do it in a way that sort of makes sense in the restaurant industry? So that's really what inKind does, is we'll fund. So we don't rely on crowdfunding, right, to fund a restaurant. We fund off our either off of our balance sheet or off of our credit fund that we have. We'll give a restaurant. The largest deals we've done are like 1.2 million to date per deal, and we're exploring $5 and $10 million deals right now with big restaurant groups. And then we buy a lot of credit, and then we over time sell that credit and get that consumer behavior, that you would get kind of through the crowdfunding, but without going through a crowdfunding.
Right. And I'm sure from a regulation point of view, it's much simpler too. There's not certainly no accreditation or rules about what you can say to who and reporting and things like that.
Absolutely. Yeah. We, because we were doing equity crowdfunding before even the SEC rules passed. So every state had their own rules. So I remember we were going to launch in Colorado, and the rules in Colorado were that you had to have somebody upload their ID before you could tell them anything about the opportunity. And it was like, who's going to do that?
That's right. Scam are us. Please upload a photo of your ID.
Yeah.
Oh man.
It's better now, and we are. I would say on the, I invest through like WeFunder, and people like that in startups. I think that's a good model. But I think it comes back to what you said earlier, which is like a restaurant's not going to have an exit. With the restaurant, you're hoping for cash flow, really, and so it's a little bit different asset class. So I'm not super hot on crowdfunding for restaurants, but I definitely would personally participate in crowdfunding for startups.
It's interesting looking at as an angel investor. I'm often frustrated by the number of entrepreneurs that I can't help because the kind of business they're trying to start just doesn't work for angel investment. It doesn't. There's kind of a narrow set of criteria, and if you don't have this kind of structure and the likelihood of this kind of exit, multiples over this amount of time, even though it's a fantastic business, it just really you can't make that connection. Right? It's not going to make economic sense for the investors or venture capitalists down the road.
Absolutely. Yeah. And I think the restaurants are sort of one of those asset classes, certainly there aren't, there's, and at some scale, if you're investing in Sweetgreens or investing in, a franchise or a big group, you might, there are definitely venture capitalists and angel investors that will do that. But, usually for an independent restaurant, yeah, it's just the economics, other than you wanting it to exist in your neighborhood,
exactly,
are tricky.
Now, I've talked to a lot of other people in these interviews and separately women and minorities about some of the challenges that they've run into because of being women and minorities. And so I thought I'd just ask, what's been your experience sort of coming at this whole space from the LGBT community?
Yeah, it's a good question. We just went through, inKind actually just went through an incubator in San Francisco called Start Out, which is an LGBT incubator. Great program.
I never even heard of that.
I actually hadn't heard of it either. And then friend of a friend told me about it, and they don't take any equity. It's non-dilutive, and they really we just finished it, a 6-month program. It was supposed to be in San Francisco, but it's virtual now. And awesome guidance and mentorship. The managing director, Chris Davidson, we're still working with him even after the program, and he's helping us with a lot of our fundraising on the credit fund side, and really awesome. So I would say, coming out of that program, and it's in particular it's for LGBT entrepreneurs, was awesome. So having that community has been great, right? Absolutely, that's definitely a positive. The company we started the previous version of inKind because Andy, my husband, who you know well, he DOMA was overturned and he was living in England and he was able to move to the US and get a fiance visa, and then we got married, and he, so we decided, hey, let's start a company together because he's a he's a corporate lawyer and I want to do another startup. So we never see each other. We both did that. So we said, let's do it together. And we started inKind. But so, for me, my personal experience has always been positive around, who I am. But I don't also know it from like, if I was a straight white person, like how would my life have been different? I don't know. Definitely, the people that we surround ourselves with are great people, right? So we don't deal with that. But when we were in DC, part of the reason we left DC was because we moved down here to Texas, which Austin's is a great place in Texas. But when Trump was elected, we were in the gayest part of DC, Logan Circle, and there were people coming into Logan Circle to, during Pride to like yell at gay people. And, there's like, these things just never happened before. And so I think, there's always, some discrimination or whatever, but what we've been able to do, I think, is surround ourselves with people who are, are community oriented and really like go out of their way, I think, to help us. I think that's actually been true too. That's probably, there was a restaurant yesterday I was talking to, and they're a little bit early for us. He doesn't have a lease signed yet. And normally, part of our underwriting, you have to have a lease signed, and then we can, figure out the funding amount. And we were just chatting, and then, it turns out that his husband, he really, really wants him to open this restaurant. It's like his dream. And then I was telling him about how my husband said, if I open another restaurant, he's going to divorce me because it's so much work to run a restaurant. And, we connected that way. And so, of course, we're going to do the deal. So, not because he's gay, but I will say that we do, we fund a disproportionately high number of minorities in our business. So there's a great restaurant in DC, mother and daughter team from Burma. Nobody wanted to finance them. No, like they went to investors, they went to banks. They just weren't what people expected would be a successful restaurateur. And we ended up financing them, and now they've won tons of awards. And everyone realizes what we realized early on, which was they're awesome. They produce great food, and they may not look like what you typically would invest in, but we. Because our underwriting isn't around credit scores or anything, it's really around, because we don't ask the restaurant for money, so we don't need them. We don't really care if they have a history of repaying loans or not. It doesn't matter to us. We look at, how is your food? Can you produce great food? And what's your hospitality like? How do you treat guests when they come in? And those are the things that we look at when we finance. And so that's, I think, part of the reason that we love inKind so much is we get to help minorities and women and LGBT entrepreneurs, who other people may pass on, but that we're able to help.
Yeah, I've seen a lot of these sort of communities of support around, for women entrepreneurs or minority entrepreneurs, and it's not, probably doesn't necessarily offset some of the disadvantages, but they definitely do help each other a lot, and it's very intentional in that kind of support. So what do you think in terms of, you're looking at which restaurants to invest in or which companies to invest in, from your perspective, kind of what are the signs to you that indicates which one of these is going to be a successful or less successful? What's sort of a make or break when you're thinking investment decisions, either restaurants or non-restaurants?
Yeah. So, Lance, I invest in a lot of like tech companies, and then I do some equity investments in restaurants, very, very rarely. And then I do a lot of inKind financing for restaurants. So on the inKind side, starting there, that's the easiest. That's, are they going to be around? Because if we buy a bunch of credit, we want to make sure that they're going to be around so we can sell the credit and people can use the credit, right? So we underwrite against that. But we also help to make sure that they do stay around. So, a restaurant, number one reason a restaurant closes, or the we've seen closures, is they get behind on rent, and then they eventually you're 3 months behind on rent, and you obviously don't have 3 months of rent. You didn't have 1 month of rent to pay, and the landlord locks you out. And the restaurant closes, right? So we'll do things like, we don't really care if you're good at managing cash flow, like I would care as much on the other sides, but in our model, because we'll pay the restaurant's rent every day, we'll take a small amount of money out of their account, save it till the end of the month, and pay the landlord. We don't charge a fee for that, but for an independent restaurant, we'll do that, and the operators will love it. They don't have to worry about saving up $8,000 for the end of the month to write that rent check. We just save it for them every day, right? So we implement little products that help them with cash flow management, help them be successful. And then of course we help them with the marketing side and with the funding and everything connected to inKind. So their underwriting is very, very different. It's really just looking at, can they produce great food? Is there a community out there that wants to buy these credits and support this restaurant and come in and like it? So that's, it's a pretty straightforward underwriting there. And it's very, very quantitative actually. So, we look at Yelp reviews, we look at Facebook likes, we look at those kinds of things. Then the middle section we'll call it the restaurant equity investments. That's actually much more similar to the tech, where you're looking at team. Early on, that's most important is team. And so almost always in the restaurant side, I would want to see a great chef, but paired with a great operator. Like you want to see that operations side. Just having a great chef isn't enough. You have to have that operations person, the person who really understands the finances of the business. And that's, I think, and then on the same is true with the tech early stage investing, as team is number one, right? And then on that side, is it a space that I can add hopefully some value, and if it's a biotech company, I probably don't add a ton of value at all. And so, it probably doesn't make sense for me to invest in that. Right. But if it's something to do with restaurant technology, for example, then, that's probably something that's really like, it's a good team in a space that I understand. I'd be probably a good chance.
So how do you evaluate a team?
Yeah. From scratching, or cutting my knees or elbows, I think the expression is, from the failures, you can kind of go, okay, I lost money on that. Let me reevaluate, how I'm evaluating. And I actually think the number one right now in my head is grit. Like, are they, in COVID, this is a great example of, are they able to sustain and pivot and figure it out? Right. And there's always going to be obstacles, and COVID is a particularly big obstacle. Right. Are they able to get around those, and are they going to stick with it? Because I think oftentimes, people, especially if it's their first startup, or they, there's always, it's easy when things get hard to quit. Right. And that, as an investor, is the absolute worst case, because I want them to continue to do it and eventually, hopefully, be successful. But obviously, if they quit, then there's no way to be successful. So that's probably like number one. And so that means, okay, who's not going to quit? Somebody who's passionate about the space. Somebody who loves, just like with us, with inKind, we've evolved, and or when we did equity crowdfunding for restaurants, right, and we pivoted from that to what we're doing today. If I didn't love restaurants, and I didn't love food, and I didn't love working with the entrepreneurs that we work with, it would have been a lot easier for me to say, okay, well, I'm going to do something else. I'm going to go back to doing computer security work, and start up in that area. And so I think having that grit, which is caused by, or part of that is having that real passion for the area that they're in. And then, of course, that also helps with, wanting to understanding the space and being involved and producing a better product of that space. And then, with the team, I think you want to look for, do these people like each other? You can kind of see that in those meetings. Are they going to stick around? Because of course co-founders are always, there's always no one's ever going to be together forever. Right. But how do they work as a team? What's the dynamic there? Yeah, that's probably the most important.
You mentioned really briefly sort of the advantage of the passion is that they know the space. And that always strikes me as something that is so important and so many really young founders kind of miss. Like, I want to create a company. I want to be a founder. That's their primary goal, is they want to found something. And so they're looking for something to do, but they don't actually have much knowledge or experience of that thing. And so they don't really have an intimate understanding of, what are the pain points? Why is the obvious solution you're coming up with not something that someone's already implemented, right? There probably is a good reason for that.
Yes, 100%. And that's, I think, those are the best founders. The best founders to fund are the ones who are in the space, have been in the space, deep in the trenches, and realize, hey, here's an improvement, right? Here's something that we can do better because we understand the business so well. Right. So if you're doing insurance, car insurance, for example, if it's a founder who's been in car insurance for 5 years and really understands the ins and outs and has an idea and is passionate about car insurance, that would be a great, founder versus me saying, oh my gosh, I have such a good idea around car insurance. Let me go and do this. And, I'm sure there's a reason, like you said, that idea hasn't been done.
I mean, it's sort of interesting that Silicon Valley kind of has this odd brain damage that they seem to love to fund recent Stanford grads with no experience in what they're doing. And, they've had some really good success, but as a systematic approach, it seems problematic and missing so many opportunities. Right? It's so obsessively youth focused as well that I think there's a big bias within the kind of Silicon Valley bubble against the 45-year-old founder who's got a bunch of experience in a space and really knows what they're doing.
Yeah. I wonder, I'm sure there's data, but I bet that overall investing in the 45-year-old founder knows what they're doing is far more likely to succeed than the recent Stanford grad. But
yeah.
I don't know.
I should look. I'll bet there is some data. If there is, I'll make a point of linking it down in the description. Maybe you get more swinging for the fences with the young kids, whereas the older people tend to be a little bit more practical. Maybe they'll hit a triple reliably, but they're not going to be the just insane thing. In part because they probably are more risk averse, right? When you're older, you've got a house, you've got a mortgage. I mean, I remember I literally had a conversation with my wife before we founded Anonymizer where I said, well, look, we're both grad students and we're renting a house at the time down the street from my parents. I was like, okay, worst case does not involve us landing on the street, right? And we have no assets, so it's not like we're putting anything at risk. We're both broke anyway, so let's try this. Worst case, we declare bankruptcy and go back to grad school. It's a very manageable thing. Whereas, you got 2 kids and a mortgage and college payments, and suddenly that equation is not in any way the same.
Absolutely. Yeah. 100%. And there's also, I think, venture capitalists will say, like, one of the things that they look for is, can this person raise the next round of funding? Right. So, we'll put it in their A with the expectation they're going to be able to raise their B. And if there's a bias towards the 20-something-year-old, in Silicon Valley as an example, then that 45-year-old founder, even though it's a great product, maybe he'll have a harder time raising the B round. Right. So there actually sort of becomes this self-fulfilling sort of negative around not, it being doubly hard or triply hard for those founders.
So we've got another instance, ageism.
Or the same applies probably to women and minorities and, the non-prototypical founder, successful founder, right? That person in their people's minds, whatever that person looks like, it probably looks like a white guy who has a degree in computer science from Stanford, or dropped out of Harvard, I guess. One of those two. If you're not that, it's just much harder. Much harder.
What are you seeing with people being able to make the shift from the angel round to the A round? It seems like a lot of the companies I'm seeing are having a huge struggle with that, and it feels like it's a bigger problem now than it was maybe 5 years ago. But do you have any thought on that?
Yeah. I think that it is harder. Now, during COVID, I think the companies that are currently doing well are having an easier time during COVID than they would have pre-COVID, because there are fewer companies competing now for those A round dollars, and the dollars are still there.
That makes sense.
So, if you had a startup in travel, it's probably not a great time, to raise an A round. But, the companies that I'm invested in who seem to have pivoted or adapted to COVID are, I talked to one of the founders of a company last week, and he said, so he just raised a round from Google Ventures, and I think it was an $8 million round, and then now that he's looking in November to even raise another round. And it's because there's a huge appetite for what he's doing right now during COVID. It's helping businesses with tax credits through COVID that they now have been unlocked, and he's growing exponentially, and so it's a good time for him to be raising. So I guess it really depends on the business.
I see a lot of now pitches where they're very COVID specific, and I've been, in fact, actively recommending people be careful about that, because as an investor, I'm saying, well, this is a great idea now, but we're all assuming this will end at some point in the reasonably near future. And what does the business look like after that? So I think it's a good argument for maybe why now, or why this is a good way to get into the space. But some of these folks are trying to build almost COVID-specific businesses. Seems very short-sighted. Yeah,
I totally agree. So I actually asked him about that specifically. I said, it's a lot of money to be raising, which is awesome, but what happens after COVID? Right? And he said, well, really our long-term goal is much, much bigger, right? So we want to do X, Y, and Z. This is an entry point into getting customer base, and allowing us then to get to where we want to go. So he has a longer term vision, and COVID is allowing him to accelerate into what he wants, to get to. So you're 100% right though. Like a particular COVID based business is going to be
right. I think it's maybe a great answer to the why now question. It's like, this gets us into the market at a scale where we can then operate in a more normal way in a year or two.
Yeah, exactly.
So we're getting close to the end here. I wanted to ask you, is there one piece of advice that you would like to give to founders, or that you give all the time, or that you really wish you'd had when you got starting?
I think, I would 100% recommend that, it has to do with community. Like, end of the day, you need to surround yourself with really good mentors, advisors, co-founders, and that is the most important thing. Like, you need people who can really give you solid advice and work with you and help you, because nobody's ever built a successful company, by themselves. And if you can do that through, an awesome incubator, like a Y Combinator or a TechStars, great. Or there's a local one in your community, that's great, that's awesome. But really go out of your way to find people to really help mentor and give you advice. And, those people you don't like, hopefully would be investors at some point as well, in your business. But Valencia and I have talked about this a little bit. Like, we love mentoring because we learn a lot from when we mentor, and
I think so many people feel nervous even asking, and they assume it's some huge imposition. They don't realize how many people are really excited to help startups, and these are typically fun people who are passionate and doing neat things. Right? It's a pleasure.
Yeah, absolutely. And our head of product, actually, we hired him because he had a startup in the restaurant space. And it wasn't going great, but he asked me for advice, and I had a couple of meetings with him, and like, oh well, if you're ever want to come over to inKind, and he ended up eventually coming over here. And I think that's part of the reason that it's fun to do. It's fun to mentor people who are passionate about what they're doing, and then with startups there's always going to be some level of they're not working out, so. There's other things you can do later with people that you reached out to.
Right. You have a network, you have relationships, you have all that in place.
Yeah, exactly.
And last question, are there any organizations or resources that you want to call out? I always like to have kind of a list of links at the bottom of things that viewers can go check out.
Yeah, I mean, we just went through Start Out, has a program called Growth Lab, that's specifically for LGBT entrepreneurs. That was awesome. TechStars, when I went through that, I went through it from their very first class, which I think was in 2007. It was a long time ago, but I'm still quite involved as a mentor with some of the TechStars programs, and then also I'm an investor in I think 3 TechStars funds, that are funding companies. And so I'm a big believer in what they're doing. Otherwise, LinkedIn is a great resource. Like, find people who and reach out to them, and
right. Don't miss the obvious things.
Yeah, absolutely.
Well, wonderful.
Absolutely.
Johann, it's been such a pleasure, and it's been way too long since we've talked. Thanks so much for coming on Fill the Boot.
Yeah, thanks, Lance. Hopefully the next time we see each other, it'll be over a glass of your
that
wine.
would be wonderful. I'm getting a little tired of this everything on screen. Talk to you soon.
Bye.
Thanks for watching this interview. I hope you found it useful and interesting, and if so, please do the usual: like, subscribe, ring the bell. It makes a huge difference to the channel and helps us get in front of as many people as possible. If you're looking for more good tips and advice for founders, please check out the other videos on this channel or head over to our website at feeltheboot.com. I hope to see you again soon. Till then, ciao.